further ado, we will have William. He's going to be going over term sheets today. He's got a lot.
Oh, okay.
Yep. Alrighty, so I'm going to give it over to young William. And you're up.
Have any people on the stream yet?
Chad, one.
Just one. Sorry. So if everybody home, I did put the lesson plan up on Circle. Also, the YC Safe is there. You can easily look it up, and the dilution calculator is going to go there. So we got a lot to get through. We're going to be talking today about the fundamentals of early stage fundraising. So this is going to be a lot of stuff. All these words you've probably heard, and some of them at least will sound kind of mysterious because you've done this like you've done before. So here's the scenario. You just pitched an angel investor who says, I love your traction. I would like to give you $100,000 on a safe note with a $1 million cap. What do you just agree to if you say yes? What just happened?
Means they're never gonna, if what they pay for your company doesn't, in terms of your valuation, doesn't matter, they're gonna get $1 million at that.
All safes are written as a post money, yes.
Yeah.
So that means that yes, you just sold 10% of the company.
Yeah.
Unless you go into a down round. If you end up closing the round when you finally issue your equity at $500,000, you sold 20% of your company. For $100,000, you probably already spent. So keep that in mind with safes, but that does not mean safes are bad. Safes are actually great for founders. They allow you to get money in fast without having to hire lawyers and a bunch of other stuff. They're just, you just don't want to be stacking them up, that's the thing. Because you don't know what you're going to close out when you finally issue equity, if it goes on for a long time, you know. But yes, that's what happened, is you just sold, ostensibly 10% of your company for $100,000. So, well, the first thing you're going to come across is people are going to ask you, for instance, what round you're in. But you might wonder what's the difference between a pre-seed and a seed and a Series A. To be honest, those words have kind of lost all meaning. A seed used to be what we call a pre-seed now. A Series A used to be what we call a seed now. People generally kind of judge them these days by whether or not you're doing a friends and family round still, which means you're not checking people's accreditation and all that kind of stuff. And this is very important. It very specifically means that you cannot advertise your fundraise. You cannot post about it on LinkedIn. You cannot post about it on Reddit. You can't do any of these kind of things. You can only go through your personal network and talk to people one-on-one and tell them that you're fundraising when you're doing your friends and family round. This is one of those things where, like, if everything works out perfectly with your startup and you mess up the stuff, it'll never come back to you. But if anything, if there are bumps in the road at all, then yes, anyone who gets upset will have cause to come back and take you to court or ask for something different, or, you know. If you did advertise your fundraise back when you were doing an F&F round, people can actually ask for their money back, which is a really tough one if you've just spent it, which you probably have. But generally, that's what we call a pre-seed now. It used to just mean you don't really have a product yet and you're raising before that, but now really it just means you're in your F&F round. A seed round is generally going to be, people put the amount in different ranges, but if you're raising, say, under $3 million, we usually call that a seed round these days. When you start getting over that, you're in Series A territory. That's usually how we kind of look at it these days. And then after that, it's just what round did you do last determines it. So when it comes to raising, I'm going to just talk really about pre-seed and seed for you guys. When it comes to raising these early rounds, there are three main vehicles people use. There's the safe agreement, which you are probably familiar with. If you're not, I posted it on Circle, so you guys can easily look it up there. There is a convertible note, which is essentially a loan that the person giving the loan, they have the option to take their payment as equity or cash. It's almost always equity, but because if the company's going well, they want the equity. If the company's not going well, you probably don't have cash. And then there is an equity round. That's just normal. That is just, you are taking money and issuing shares in exchange. Like later rounds are almost always going to be like this. You get Series A, Series B, Series C. Nobody wants safe notes. You might see convertible notes, but people will have an expectation that they're getting their equity in the next few months. And the purpose for those other things, for the non-equity round, the non-price round, is partly because it's a little cheaper and faster. You don't have to hire lawyers. If you're drawing up contracts and stuff like that, you're gonna want to think $5,000 to $15,000. Most founders don't want to, throw that down for their seed round. Especially like that might be 15% of your whole round if you're raising $100,000, right? But the biggest thing is you probably don't accurately know what your company's worth. And that is one of the reasons why you want to look carefully at the valuations you're giving on safe notes and why you don't want to take a bunch of them. If you took every year you took another $1,000 safe note at $1 million valuation, and then later on you closed your round at $20 million, 3 or 4 of those things is 40% of your company gone. At $1 million, right? You sold 40% of the company dirt cheap. This is one of those things you do see sometimes where people they don't know how much money they need, they don't know how much they're worth, and so every year they go back and ask for another $100,000 on the same kind of safe note they had last time. That was pretty easy. And then they blow up, and suddenly they're worth $20, $50, $100 million. Those safe notes all come due when you issue that equity. So that's one of the things to keep in mind. And that is, we're going to talk about this later, but that is the difference between pre-money and post-money valuations. Like I said, the equity round, that one is the simplest. That's the one where you're going to...
Your destination is on the left.
There's a reason, or a list of reasons why everybody doesn't want to do equity rounds at the beginning. Again, valuation and all that kind of stuff. But the biggest thing is, there's a whole bunch of documents you have to put together when you do your equity round. You have to put together probably a term sheet. You can do it without it. It's a really good idea just to do a term sheet. One of the biggest reasons for that is, a term sheet is you writing 80% of the contract, and then going and paying a lawyer very little money to just fill out all the boilerplate stuff and tell you if there's anything illegal in what you just wrote down, right? If you had just had your lawyer negotiate it for you, think $50,000 to maybe $100,000. Really different pricing. Whereas if you've got a term sheet, you might do it for $5,000 or less maybe, because they're just filling in the boilerplate stuff. You have to put together stock purchase agreements, investor rights agreements, amended, restated. You have to restate your certificate of incorporation when you issue shares, if you're making new shares especially. Or if you're just issuing shares you authorize, you have to do a little amendment. You have to figure out how you vote on things. You have to figure out if anyone has right of first refusal or vetoes or any of that kind of stuff. All that stuff has to be put documented on paper. And generally that costs money to do. And that is one of the reasons why pre-seed and seed rounds, they are rarely an equity price round.
From that perspective, if the investor, for example, obviously most investors, if they can, assuming most investors should and will know more than us, a lot more than us, if those kinds of things are not enshrined in a document, they're not bringing it up. Obviously, we're kind of in the right we don't have to protect against it, correct? If it's not in the document,
Not really.
contract, then we don't have to worry about it.
If it's not written down, then it just goes back to your charter, the charter that you put together when you incorporate it in the first place, basically.
Gotcha.
You'll have written a charter that says our board works like this, authorize this many shares. If it's not in there, then they don't have it. No one just automatically gets veto rights. They have to ask for it. And you can negotiate all that stuff. And even if you're doing some big time investor like Sequoia Capital hands you their standard contract that says this is the standard contract. I've seen that contract is long. You can actually look it up. You can look it up on their website. They'll let you just go through it. You can go line by line and say hey, they have a liquidation purpose in there, right? And it is I'll make it to this later, but it's what they call double dipping. You would definitely negotiate that out. Everyone who asks to take that out, they do it. There's a lot of that kind of stuff that you would have to dig.
Just want to make sure I understand this correctly. Are term sheets set in stone, or can they be amended?
Term sheets are not binding documents. Anyone can walk away from term sheet at any point on either side of the table, you guys or the investors. This is one of the reasons why you don't see a lot of NDAs being signed in this kind of stuff, but you will see no shop clauses, like written down and signed and enshrined in a term sheet. Because the VC doesn't want you to take your term sheet to somebody else and go, what can you do better? They don't want you just walking around with the term sheet. You can go and tell somebody, basically, kind of, what terms you're looking for. And you can tell them you've already got good terms or something like that. Or you can listen to what they have and you can say, I've already got better terms. But you can't just show them the term sheet if you have a no-shop clause, which is very common. Although, honestly, pre-seed, seed rounds, you're probably not going to see that much. Later on, though, if everything goes well, you will start to see that kind of stuff. So, yeah. Like I said, this is not a binding contract. And term sheets tend to be very fluid right up until the point that you hand it to the lawyer. Everything is still up for negotiation. All right, so a safe note has a bunch of different options, a bunch of different parts to it, a bunch of different ways to do it. The simplest for both an investor and a founder is what's called an MFN, or Most Favored Nation safe. That just guarantees that the investor gets same terms as whoever got good terms in this round. Generally whoever got the best terms, unless you're doing some weird shadow round thing. You don't need to get into that, honestly, in the first round. But an MFN safe is just super easy. The money goes in and you guys can get going. You don't have to worry too much that you've given up too much, and except for whoever your lead investor is. Generally, whoever you have as a lead investor eventually, that will set the terms for all of those MFN safes. But it is really common for early investors. Oh, sorry, Dan.
Question on the MFN, does that allow the investor to invest more on the MFN, does that allow the investor to invest more at the same terms later on as well?
Okay, so now we're getting into a tricky part of safes. Even the MFN still writes into its terms that whatever it gets, whatever valuation it gets in the end, has to be a post-money valuation. With post-money valuations, you cannot just, or you don't want to just take money infinitely. If you are valued at some point at $3 million and you raise $3 million, that's the whole company gone. But if you negotiate as a pre-money valuation, pre-money $3 million, right? And you raise $3 million, you're worth $6 million. You only sold half the company. If you have $100,000 in your bank account and I give you another $100,000 and you put it in your bank account, you're technically worth $200,000, right? Your company works the same way. If it was already worth $3 million and somebody gives you $1 million, you're worth $4 million now. So, if you can negotiate a generally to get good pre-money terms, you kind of have to have like a product that's out there, and at least some sniff of product market fit. You have to have like a way for people to look at it and be like, I can see what this is worth. You know what I mean? Because it's real hard to tell what it's really worth before it hits the market. But if you have that, then yes, you would want to be, if you can, you would want to try and negotiate pre-money terms, especially if you don't know how much money you're going to have to raise. Everybody thinks they know. Everybody thinks, well, if I got $1 million, I put $500,000 in the bank, and I'd only need $500,000, but nobody ever puts any money in the bank, or keeps it there anyway. So if you are unsure how much money you're going to have to raise, then you would want to negotiate at a pre-money valuation. Even if it's super low, even if it's very low, it still would be advantageous to do if you can. By the way, I'm an investor, so I spend most of my time trying to tell founders to take post-money valuations, because that's good for us. And here's the other way to look at it. I was giving the example of $3 billion and then you raise $3 million a minute ago. When you do a pre-money valuation, everyone takes the same dilution. When you do a post-money valuation, you take all the dilution. Well, you and your previous investors, whoever's already in the company. Post-money valuations mean anyone who's already in the company takes all the dilution. Whereas pre-money means everyone shares that dilution. And in case you're ever actually sitting across from people from Sequoia and they're trying to give you this, liquidation preference thing, or they've got like what's called a full ratchet anti-dilution clause they put in some of your contracts. If you tell them you'd like to take a what's called a weighted average anti-dilution clause, they'll usually do it, which again means that everyone sort of shares the dilution. You'll take a little more, but it allows you to raise more money without giving the whole entire company away. Wow, we talked about safes quite a bit actually. Going through that. Real quick, I went over pre and post money. Is everybody pretty solid on that? All right. Liquidation preferences. Now this is a thing that trips people up quite a bit. A liquidation preference has two types. The most common is non-participating. That's just normal. That means that if, so you're getting, as the founder, you're getting your equity for free, right? Basically. And if somebody comes in and they give you a $10 million valuation, and they give you $1 million, right? They might put in a non-participating liquidation preference that just says that if you sell the company later, they get at least their $1 million back. Now that might sound weird, but one of the reasons for that is, conceivably, you got your equity for free, and someone came to you and offered you $5 million, and the company's not going that great, you might just go, hey, I just got $4 million for free. You know what I mean? If you own 80% of the company or something. So for you, it sounds great. The other guy only gets half of his money back if he doesn't have a liquidation preference. Yeah, if you sold it for $10 million, you'd get exactly the money back. But that's generally a non-participating liquidation preference. That is the most common. The word you want to look out for in a contract, you don't see it often, but you will see it sometimes, is a participating liquidation preference. That's the thing Sequoia does, I was talking about a minute ago, called double dipping. I'm not trying to rag on Sequoia, they just have a lot of pull, so they can put a lot of stuff in their contracts. A participating liquidation preference means if you sell your company for $10 million and they have a $1 million participating liquidation preference, right? That liquidation preference is essentially debt. You have to give them their $1 million back first, and then that investor and everyone else splits $9 million. So that $1 million comes off the top. And then everyone else splits whatever's left after that. Yeah, it's real tricky because they don't, like, there's nothing in the words participating and not participating that just, like, explains that to you. It's not intuitive, right? But that's one you want to watch out for. If you see the word participating, tell them you'll take a non-participating liquidation preference. That rarely ever hurts the balance.
Just going back real quick, on your pre and post thing, I understand everything you said with the concept of liquidation preference. Why would a post money evaluation, wouldn't they not be diluted anyway because they're not even involved with the company yet? Or can you explain what you meant by with post everyone's diluted?
Everyone except that investor. So a post money evaluation means they are buying a strict percentage of the company. With a pre-money valuation, if you take more money, if you take more safes or more convertible notes or whatever, before you issue the shares, then, like I said, the value of your company goes up. So they're not getting a strict percentage. If they come in first, you're pre-money $3 million, and they give you $1 million, you close right there. You get 25%.
Yep.
Of $1 million and
Yeah.
40, right? But if you realize, oh my God, like $1 million is not nearly enough. Somebody else just entered the market and I have to compete. I need another $2 million. Now they only get 1/6
Yeah.
instead of a quarter of the company.
And that happens, they're willing to negotiate that sometimes? Or is it because you go
I
back
mean,
to them to get?
like I said, you weren't technically worth $6 million if they believed you were worth $3 million in the first place. You know what I mean?
Yeah.
Now, early on, people are usually going to want to give you a post-money valuation. Like I said, it's very hard to figure out what you're really worth. Later on, when the company's going really great, you've got, X number in revenue, and you're growing, 20, 30%, you know, month over month and stuff like that. Intrinsic value in companies, even public companies, is hard to calculate, hard to like be accurate on, but people can get a pretty good idea of what they believe you're worth. You can do DCF, like discounted cash flow valuations and things like that. You can do multiples on revenue. There are a bunch of different ways to be like, this company should be worth at least this much right now without taking my money. And if you're in that position, you're probably not under existential threat. You probably want money to grow rather than money to just like exist. You know what I mean? So at that point, pre-money valuations are not that hard to negotiate. People will probably come to you with a post-money valuation first, and you can say, look, I will give you a lower valuation, but I want to be pre-money because I'm aiming to raise again before I issue these shares. Spotify is a good case of a company that did that like in multiple rounds. Now they raised from a lot of like European investors, they're a little different, but you'll see lots of companies that do that. But yes, that's
very helpful, thank you.
Could you explain valuations based on multiples of revenue?
honestly, I wish I could. This is a tough one. It changes all the time. Pre-COVID, it was common for fintechs to be getting a 10x revenue multiple. And then post-COVID, all of a sudden it was 4x. I don't know why. Honestly, I mean, it's not like the fintech industry had like some upheaval during COVID. Not really. That's just. I mean, part of it was that investors just shifted their focus from fintech to AI, and so they weren't willing to pay as much for shares in a fintech company, unless it was also an AI company. And AI multiples make no sense. There are AI companies worth billions of dollars right now with no revenue, or well, not no revenue, but like no profits. You know what I mean? So I do wish that I could explain to you exactly as it is. The best advice I can give you on that is to look up comps in your industry. Look up what kind of revenue multiples other companies in your industry have been getting recently, and you can ask for something comparable to that. Or at least it'll tell you if what they're offering you is way too low. If a lot of ed tech companies are getting a 4x revenue multiple, 3x is fine, 5x is great, 1x is obviously way too low. You know what I mean? 1x, they're essentially just saying, we don't really believe you'll make this amount next year. And if you have negative growth, I mean, there might be a reason for that, you know? You look at your own company and figure that out. Like I said, it's not just looking at revenue. If you've got revenue plus growth, you're going to get a much higher revenue multiple. Does that explain it pretty well?
Yeah.
Like I said, it's not one of those things that has like a strict formula that works all the time.
It's more like just an art, basically.
Yeah, there's a bunch of stuff that goes into it, including investor tastes, unfortunately. Yes, Ben?
Rough order of magnitude range, what would you expect the companies in this cohort to be valued at in their first round? From low to high, just gut.
I mean, honestly, companies going through an incubator like this,
Especially this.
yeah, well, not really. Like companies going through an incubator with what is essentially a 12-week due diligence process. We actually can verify to any investor you guys are real people working on real businesses. I mean, that's a real worry at the beginning, you know? That you will show up here at 7 in the morning, which means you'll probably keep doing this, even when it's hard later. Even when like you haven't paid yourself for like 6 months and you're eating ramen noodle and stuff. You know, like somebody coming out of a program like this, probably $1 million. Like on the low end, you're probably worth at least. You would probably be able to get to fundraise at $1 million. I'm actually not going to say that's what you're worth, because you could certainly be worth more or less. It's really hard to tell at the beginning. But if you just want a nice round number, it should be fairly easy for you to negotiate $1 million valuation. Especially coming out of something like this, unless you've got a company with a very low ceiling and you know things like that. Because you want to think like people want to think that there's at least a potential for a 100x return, because early companies are so risky. So if your TAM is $100 million, so we're in that range, and you are an early company coming out of an incubator with this background and everything, yes, you should be able to negotiate $1 million valuation. Well,
Thanks, yep.
all right.
Oh, let me add one thing real quick. A comment you made about, we see people showing up at 7 a.m. Well, 9 or 10 weeks into the class, we see who's still showing up at 7 a.m.
Well, yeah, that's true. I mean, and some of the people are on stream as well, but you're right. People who, that's one of the reasons why a lot of VC firms run these incubators, because they get to see who all these people really are and what they're made of before they give them a contract of $1 million or whatever. Before they give them that, because at this early stage, you're doing safe notes and stuff like that. You don't necessarily give a board seat to all your investors. They might not have any real oversight of what you do with the money. You might just pay yourself. And then go, you know what, this was a bad idea. Or you might just go like, it's really hard. It's really hard. I'm just going to close down and split the money. Even though it wasn't all your money that you put in. You know what I mean? So yeah. What was it again? Did you say last time?
I was just asking about evaluations, but I was just saying, we find out who's really committed 19 weeks into the incubator.
Yes.
Not just who started, but who finishes.
Yeah, it's who finishes. Like I said, you don't, I won't get into it too much, but I've seen like a direct case of a founder who went through an incubator, finished every single part of it and got funded. Another founder, not that dissimilar, but just didn't finish everything. Had the money like it was his to take, and he just didn't get it because he just didn't finish everything. And that, no matter how good his business is, that told the people running that VC firm that this person is not a person who will drag this thing to the finish line. Now, you don't always get to the finish line no matter how hard you drag, but they want to know that you will drag it.
Well said.
All right, so some essential terms in a term sheet. We've gone over quite a few of these. Pre-money and post-money valuation. I think you guys have a pretty good handle on that. Liquidation preferences. Anti-dilution is what we were talking about a minute ago. People will actually use the words full ratchet anti-dilution in the clause a lot of times if that's what they're asking for. If you see that in the clause, you got to make kind of a judgment call. It might be fine. You know exactly how much you're going to raise. You are doing well. There's no reason to think you're going to have to give the money back. And you really want that VC or that person on your cap table. Maybe it's like, Bill Gates. And he happens to operate in some industry and he can help you all. Or you know what I mean? Like it's like some, like the coach for Kentucky basketball or something like that. You'd be like, look, I'll give John Calipari whatever terms he wants to give him on the cap table. But generally, if it's not that kind of situation, just tell them, look, I'm happy to do an anti-dilution clause, but it has to be a weighted average anti-dilution. So that's the word you want to use, weighted average. That means they still get good terms, they still get a little better dilution than you guys do, but it still gets shared a little bit, so you don't have the danger that you accidentally just gave up your whole company if you happen to go into a down round. Some of the control terms you're going to look out for are board seats. That's one I'm sure you guys have thought about and heard about. Basically, you just don't want to give one investor control of the board. Or really, like you don't want to have a group of investors that all knew each other and put the round together. Then every one of them gets a board seat. And now they've got 6 board seats in a 9-person board, right? It's not generally that big a deal, but like just avoid it, just in case. Just so you don't get voted out of your own company as CEO, essentially. The board is there to protect, for the most part, investors and to give guidance and things like that, but largely to put guardrails in case you start to go crazy. But yeah, just watch how many people are on the board and who they are and how they know each other, things like that. Different protective provisions that come up. Investor veto rights are probably the biggest one. And this is not a terrible thing, but you want to know it. You want to know that those terms are in there in the future when you're doing things. If someone has veto power over you selling any of your shares, for instance, that means they're the only buyer. So they would set the price. They would tell you how much you can sell it for. You might not like the answer. If you don't think you're gonna sell your shares in that way, and like honestly, if everything's going well, this stuff doesn't come up. If things are going great, the company's just going up and to the right, they'll, like the next time you do a fundraising round, they'll probably let you sell 10, 20, 30% of your shares and just take some money on it, you know? They don't want you to be living on ramen forever. They want you to actually focus on the company. So yeah, if everything's going great, then you probably won't have this problem. But if everything's not, and you're like, I need to dump some of these shares, I actually need like money for rent and car payments and stuff like that, you want to know that that provision is in there. Like I said, it doesn't mean it's a deal breaker, but you want to know that it was there. And you can ask people to take that out. And there are like all kinds of different major decisions people might ask for veto rights on. They might ask for veto rights on, like, you know, doing the next round. They might be able to veto a down round or things like that. They probably wouldn't if it means killing the company, but again, you want to read the contracts and know what veto rights are there. And then information rights. This is one that every professional investor will put in their contract. Basically, it just means they tell you how often they want you to tell them what's going on with the company. Monthly updates, quarterly updates, annual updates. It kind of depends a lot of times on how big of a team they have and how many investments they have, like just how many of these updates they want to read all the time. You'll sometimes see one-man shops that just want an annual update because they just can't read 30 of these every day, you know? But it's a really good idea if you're thinking this is going to be a large and profitable company, which all of you probably are. It's a really good idea to just get in the habit of doing quarterly updates because the SEC is going to require you to do that one day if everything works out anyway. If you go public one day, this is what you're going to have to do. So generally, you might have your CFO do most of it, but it's just a good idea. Also, as the founder, it's a great check-in. It forces you to sit there and look at your company and know what's really going on. It's really easy to ignore the bad parts and focus on the good parts sometimes and stuff like that. But it's great once a quarter to just look at it and be like, oh man, I really got to work on this. I got to tighten the screws down on this thing over here. But yeah, so it's an update for you too. Yeah.
One more thing to add to that too with updates is investors talk to other investors, and one of the things they talk about is, does this guy that you already invested in, I'm looking at investing in, send me regular updates. And they might even share those updates behind the scenes before talking to you.
It's funny, a good example of that is Eric Bond. You can probably just leave with that. A good example of that is Eric Bond, who founded Hustle Fund. When he started Hustle Fund, he went around to all these LPs, all these institutional investors, and did his pitch and everything. And he said one of the big things was he was going to do weekly updates, and they were all skeptical that anyone would do that because that is a lot of updating for a VC fund, especially at the time it was one guy, right? But they didn't give him money. But he said, look, I'll put you on my update list anyway, so you'll be able to see what's going on with the fund. You'll be able to see what kind of progress we make. You'll be able to tell if we're doing a good job or not. Maybe next year you'll want to do the next one. He put like hundreds of people on this thing, and he actually put out weekly updates. He actually did it every week, and he still does now. It's been going on for like 8 years. Still does weekly updates for this very large $100 million AUM fund. And yeah, the next year, a lot of institutional investors just said, look, I can't tell if you're good at this or not, but if you are looking at if you're digging into your own numbers this often, you're gonna get good at it. At least you know what's happening in your own fund. Some fund managers don't, frankly. And yeah, the next year he raised, I can't remember what it was, but it was a very large sum. He went from basically like $3 million to like $50 million. Based on that, based on promising to do a lot of updates. You don't have to do weekly updates, by the way. But every investor that you talk to that says maybe or later or those kind of things, ask them if you can put their email on your investor update letter, and then actually put out the investor updates.
That's a brilliant trick there. That works.
It constantly reminds them that you exist, and if you are making progress, they'll see it. And frankly, like if you're having tough times in your company, they'll see that you're open and honest about that. They might come in and be like, you know that problem you've been having? I have seen that a bunch of times. I know exactly what's going on here. $50,000 would fix that. Like, that happens.
Do you not want to be protective of those updates?
Well, okay, I know what you're talking about. You're saying that you might send them out to a VC fund that is invested in your direct competitor, and they might just turn them over. So you're not going to be putting like the details of your technological breakthroughs in there. You're really going to be just putting financial information, stuff that if a competitor really wanted to know what your CAC looks like, what your customer acquisition cost, what your churn looks like, what your costs look like, they could probably find out. They'd have some people sign up on your platform. They get an idea of what your cost looks like. They would, try and get like a list of people who have signed up in the past and dropped, and send them surveys. They don't even pretend to be you, or to be some company you've hired or something, right? And ask them why they quit, and they would, do some calculations to figure out that kind of stuff. This is mostly stuff that a really interested and well-funded party could probably figure out. And since you're only sending the money out to investors, you're only sending these updates out to investors, anybody they hand it to is funded. Generally, the best way you can be secretive, you can work in stealth mode if you're doing something crazy and you don't want anybody to copy it and that kind of stuff. It's possible.
Well, I just mean more in terms of, like, does it not, for example, being open and honest with your current investors, is one thing, but especially when you're looking at, obviously, if you're posting an acquisition or something, that all changes, but even like open to whatever your next round would be, and then you're talking about, well, I'm really running into these struggles. It's not exactly that. Some people really respect that, but a lot of, especially angel money and stuff, aren't going to necessarily want to hear, can't get customer acquisition down right.
Unless it's in a contract, and honestly, even if it is in a contract, there aren't really legal requirements as to what you have to put in updates. So you can use a lot of your own judgment, that's what you want to put in there. You don't have to provide bank statements or anything like that. In fact, I wouldn't do that. Nobody does that. You just give general numbers and the numbers that you feel like putting out. And you can very easily make two lists. One list of people who did not invest and one list of the people who actually did invest. You give a detailed analysis of people who invested, and then you give your cut down version of just the stuff you wanted to hear to the people who didn't invest.
I guess ultimately my question in this, and I'm starting to get stuck on this, is depending on, obviously everything's a judgment call, how much founder do you want to treat your investors? You know what I'm saying? You want to be a cohesive team amongst your board or whatever, especially in the pre-seed times. You want to bring them along for the ride. Do you need to treat them differently than you would, for example, a co-founder?
Yes. Primarily, if they didn't ask for any information, they didn't ask for updates, you don't have to send it. Like I said, it's good practice just for you. But the thing to remember about your investors is they're not employees. They don't have any actual responsibilities for your company. They all want to help you. They all want you to succeed and stuff like that, but they don't actually work there. And yes, there is going to be a lot of insider information you don't necessarily want to give them. I will say there is kind of a trend right now in VC where people will make small investments in lots of different kinds of companies that they're not necessarily interested in, but they're interested in learning more about the space. Like you might invest in CoreWeave was a private company until now. There were lots of people who invested in CoreWeave, and really all they wanted was to get their quarterly updates so that they could know what the future looked like at NVIDIA, right? So they'd be like, whoa, they are going to spend $150 million next quarter, and they only spent $50 million last quarter, right? NVIDIA stock's about to shoot through the roof. You will see that kind of stuff. But that's not really, they're not trying to destroy CoreWeave. They're just using sort of an asymmetric information advantage, But yes, investor updates are a good thing.
Got it.
And you can use your own judgment as to what you want to put in them, unless someone put in a contract specifically that they need something, which is unusual. Usually they just say, I want updates. And to be frank, a lot of them aren't gonna get ready. So when it comes to this kind of stuff, I think I've gotten this already, but the red flags to avoid on your early term sheets, early safe notes are going to be participating liquidation preferences. The word participating is what you're looking for. Full ratchet anti-dilution, which can have brutal punishment in a down round. And again, the YC safe is already basically full ratchet anti-dilution. It's just that, like, you're trying to get money in quickly, early, just watch valuation cash, just pay attention to them. And then excessive board control. You don't want someone getting 3 seats unless you really just want them to control the board. You think they're better at it than you are. But generally, yeah, you don't want to give up full board control too early in the company's history. So, when it comes to term sheets, like I said, I mean, pretty much just going over those red flags for the sake of it, that's going to be pretty much the same thing. All that stuff's going to be in your term sheet, and you're going to want to negotiate up and down based on those things. Usually, for all the things that are, like I said, that are terrible deals for the founders, there's a version that is a great compromise for them. Switching a participating liquidation pref to a non-participating. Most of the time, you can do that. If they won't take that, they probably don't believe your company's going to succeed, to be honest. Or they're just very greedy. Switching full ratchet anti-dilution to a weighted average anti-dilution, that's another one most people will take. One of the biggest things you guys are probably thinking, though, is like, when I'm raising money, which one of these types of contracts should I be thinking about? Safe notes, convertible notes, just issuing straight equity. There are advantages to all of them. The biggest part, like I said, if you do a straight normal round where you just take money, you give people shares, you are stamping the valuation on your company at that point. And you can go too high or too low. You don't need to worry about this too much at the beginning, as long as you're not selling tons of your company. If you're selling, you want to try not to sell more than 20-25% of your company in the first round, if possible. Just because you're probably wrong about valuation. It's okay to have a fire sale at the beginning if that gets your company bigger, you know what I mean? If it's what you need to grow, then absolutely, take that money. But don't take too much. Don't give away too much of the company at those fire sale prices. And also, be careful about overestimating your value. I talked a bunch about the dangers of a down round and how it can slap you in the face if you've taken a bunch of safe notes and various things like that. Also, a down round is just considered a very bad omen for a startup. Remember that no one has to invest in you. You're competing with every other startup that exists and 100 more that don't exist that will tomorrow. So no one has to put money in your company. And your previous investors, if they see a down round, if they see a bunch of negative signs, they will just tie off the investment. They will double down on their winners. They don't really invest in life rafts. You know what I mean? So that's another reason to be realistic about your valuation. Don't just automatically raise it $100 million. Which you might laugh at that, but I've had people. I actually had a meeting not too long ago with a guy who had a company, had a general mock-up of his website, didn't really have it on the market yet, didn't have any customers yet. When I asked him what he was raising at, he said, well, every $1 million that goes into this company gets 1% of the company. I was like, so you're worth $100 million right now with no revenue and just barely a profit.
For revenue, AI SaaS model instead of others.
So that is, if one person invests in that company, it is almost certainly destined for a down round, and probably a brutal down round when he gets to real investors, or they just laugh at it. You know what I mean? So like I said, that's why you want to be just sort of realistic. And that's for priced equity rounds. Safes, moving over, like I said, safes are for when you need to get going now. You just need to get money in the bank so you can just get going. That is when you want to use safes. Also, you want to kick your valuation down the road. There are two vehicles for kicking the valuation down the road. Safes also are good when you don't know how much you're going to raise or how long, but you want to watch those valuation caps if you're doing that. And you want to keep track of how many of them you're stacking up. Convertible notes are also really common. They're especially big in bridge financing rounds where you potentially would have a down round, but you don't want to take the down round. You take a convertible note. The things to remember about convertible notes, though, are that they are debt. They go on your balance sheet as a debt. They accrue interest. So the number that's on there is not actually the number that you have to give out later. It is technically possible for your investor to come back and say, I don't even want your equity. Give me my money back with interest. You could end up in that position.
This is random, but going back to what you were talking about earlier, the difference, I think we're all obviously at a pre-seed level, and so the whole like friends and family or whatever else. If I'm at a conference, a sports tech conference, and I meet somebody and they're super excited, blah, 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 are there any, obviously red flags to look for, whatever, we've talked about that, but are there any legalities or things that I need to be doing to protect myself and how I approach talking about fundraising or anything else? Obviously, I know it's not be broadcasting on LinkedIn, but if, I talk to 30 people at this, to fundraise, is that going to be a problem? Is it just still your personal network?
So the thing I've been told a bunch of times is that if you are at an event specifically for investors looking for founders, and you have a reasonable belief that everyone you're talking to should be an accredited investor, you're okay to talk to them about your raise and the numbers based on it and everything. And especially in your friends and family round, the biggest thing with your friends and family round is you have a cap. There's only so many investors you can take without having to check their accreditation and stuff like that. I think it's 35, and you can't raise too much money. I can't remember what the money cap is, but it's like $10 million. So if you haven't done $10 million yet, you haven't got 35 people yet, you can continue to do this through a personal network. You can get on stage in a room full of people where you have a reasonable belief that everyone there is an accredited investor. But you cannot just stand up on the table at Taco Bell and announce your fundraise.
Maybe especially Taco Bell.
Yeah. If you're raising for a video game platform, you might get that money at Taco Bell. I don't know. You know what I mean? Like for real. But at that point, you are now you're a 506 D, I think now, or C. Yeah, you're a 506C, which means that before you take their money, you have to go and check to make sure that they are that rare millionaire that goes to Taco Bell. So yeah, it's not that hard actually. It's just that you might find out they're not accredited. That's the other thing. But it's not that hard. There are lots of services that will do it for like $70, stuff like that. If you have a lawyer or retainer, they'll probably just do it for free. But yeah, in your F&F round, yes, if you have a good reason to believe that everyone at this conference or event should be an accredited investor, it's fine to talk to them one-on-one, or even get in front of them and talk about it. That's what a pitch competition or a pitch event is. And until you have publicly advertised your thing, you only have to ask people, are you an accredited investor? You don't actually have to get a bunch of financial statements or anything. You just have to ask. And they can lie. And that's fine.
Because I guess the reason I was asking is, like, LJ or any of the other ones we were looking at, you literally have a slide that's like, I'm looking for $400,000 or whatever. That's pretty common.
Take that slide out when you are not at a place where you think everyone is an accredited investor. Just take that slide out.
Yeah. So you do have to keep an eye on something
Yes.
like that.
You do. You can actually put that slide deck out publicly without that slide. You can put the slide deck on LinkedIn. You gotta take that slide out, yes. When you put it out with that slide, you're technically 5 to 60. You can probably get around that maybe, but like, if you think you're gonna be big and successful and have a large profitable company, don't do it. because it may come back to bite you later. All right, we're getting close on time. Dilution. I want to get into this one because this is one of those weird, mystical things people ask about all the time. It's really unintuitive. So the way dilution works is generally you're going to be a C Corp. If you're not a C Corp, you may not have to deal with this. But as a C Corp, when someone buys shares from you, there are two ways that can work. You can authorize a lot of shares that you don't use at the beginning of the formation of your company, right? So you can authorize, let's say, like you form your company, you, the founder, take 10 million shares, but you've authorized 12.5 million. Okay? So that means you don't have to go out and make new shares necessarily. You don't have to issue shares. You just have to, or you do issue shares. You don't have to like authorize a whole new set of shares. You've got 2.5 million. You can sell those. But what happens is, initially you had 10 million shares, and those were the only shares out there. So you owned 100% of the company. Now you make 2.5 million new shares that you give someone. That means you still own 10 million shares. You still own the same number of shares. But your percentage of the company goes down because the company itself grew. It's like you're getting the same amount of a pizza, but the pizza got bigger. So there's just more slices. There's just more slices going around. So in that particular scenario, you had 10 million shares, you sell 2.5 million that didn't exist before. You went from 100% down to 80%. But you own 80% of a bigger company. That's generally the way to look at it. People get real weird about dilution and like not wanting to lose any of their ownership and stuff like that. But if you are doing this right, and your company's doing well, what's happening is you're getting a smaller ownership percentage of a much bigger company, which is generally advantageous. Do you guys have any questions about dilution? It's a real confusing subject most of the time.
I might have a question.
So what about dilution? So I was doing numbers, right? So
Yeah.
Dilution, pre-money valuation, post-money valuation. I was doing numbers, and I was getting different percentages.
That is correct. We went over this earlier. That's
Oh, did you?
why if you can negotiate pre-money,
Pre-money.
you
Oh, I
want
see.
to do it.
Gotcha. Thank you.
Because the dilution happens either way, but in a pre-money valuation, the dilution is shared amongst all the people involved. And in a post-money valuation, just the current shareholders take all of the dilution. That's why investors always want to push for post-money valuation. And that's why, as founders, if anyone's ever told you this before, you'll know you always want to take pre-money if you can. Post-money doesn't hurt you if you know exactly how much you need to raise, and that is all you need to get to your next milestone and so on. Post-money is fine. It's not some terrible deal. But if you are not sure about that, you want to try to negotiate pre just because you may need more money later. Is that kind of?
Yes, sir.
All right. I kind of went over how new shares come about. It's one of those things that's not intuitive and kind of tricky. But essentially that is the reason to be a C Corp is when you're taking investment dollars, you're not selling your personal shares. If you did that, that's your personal money. It doesn't go into the company. You know what I mean? So what you do is, as a C Corp, you make new shares. If you haven't authorized them already, generally what you have to do is go to your board of directors, and they would send out like this little shareholder vote thing that usually gets rubber stamped. That allows you to put an amendment on your thing. You have to generally have a lawyer. It's pretty annoying. Which is why you want to authorize enough shares at the beginning. And you can call your extra shares an employee stock pool. That's what people usually do, but you can sell those, just so you know. If you haven't already given them to employees. But yeah, you have to put an amendment on your charter that says you're issuing new shares. And to put the amendment on, if you have previous shareholders, usually you gotta just ask them. But yeah, that's what happens is your number of shares stays the same, but your percentage goes down as the number of shares that exist goes Does that make sense? All right. We are just about at time, so it's probably, I got a few more things, but it's probably a good idea to just go into a Q&A if you guys have any particular questions about anything. Doesn't have to be the stuff I've said, it could be anything you have seen or heard about in the contract, or anything in particular that you're worried about, or just been unsure of when it comes to the terms in a fundraise, or how term sheets go. You guys have any questions about
Can you sign
anything? Yes, Dan.
So most people in this room will raise their first round on safe notes. You'll go to the YC website and you'll see 3 different forms of safe note. William, which one of those templates would you recommend most people in this incubator start with?
Okay, if you can, get your investors to do either the MFN safe or the no cap discount safe. The no cap discount safe basically is a good deal for everybody. It gives them a discount on whatever the round closes at later, but it doesn't lock you into that post-money valuation. And actually, most investors are comfortable with a discount, with no cap and a discount. Most investors are comfortable with that. So if you can get those, do those. Like I said, if you know for sure how much money you need before you're gonna issue shares and stuff like that, then post money doesn't kill your startup or anything like that. It's just you want to be sure that the money you're raising is going to get you where you're trying to go. If you have no idea what your runway looks like going forward, or how long the runway needs to extend before you finally issue shares and stuff like that, try and avoid a post money valuation.
No cap is effectively pre-money, right? I mean,
Yes, it is. That's correct.
And then you said MFN?
MFN, that's a most favored nation.
Oh, that's
Safe.
One way to think about that is look at the safes on the YC site in reverse order. They go from least founder friendly to most founder friendly.
They're put in there for the investors.
You want to go up from bottom up.
Yes.
Starting with MFN.
Most favored nation is the most simple and fastest to get going. If I'm doing a small investment in a company, I usually do a most favored nation safe, just because it gets us going faster. And I'm not super worried about bogging them down with evaluation. On my end, sooner or later, hopefully, they'll have a lead investor in the round. That person will negotiate decent terms, and I'll adhere to those terms. That's the big thing is, if you can get people to do most favored nation safes, then you only really have to negotiate one hard contract, and everyone will inherit those terms. And if they are saying, look, I'm taking a big risk, I'm coming in early, et cetera, give them a discount. Like, they are taking a risk, they are coming in early, they deserve something extra, give them a discount, it's fine. Like I said, if you can avoid the valuation cap, do it. It's not a deal breaker. If you need the money and you know what you're going to do with it and everything, take the valuation cap. But if you can avoid it, do so. Tom?
Is there any nuance or, I don't know, just kind of different things that have to do with the opportunity zone with any of these types of agreements, or the way that the opportunity zone would be structured as an investor?
Actually, it's a pretty good question. If you are a QOZB, then there are a lot of scenarios where you can't take the convertible note. So that is the one to keep in mind. If you're a QOZB, then the convertible note actually does, it's not really on your end so much, the investor who's giving you a debt, that does not count as their QOZB investment. And they may not know that. And they may get very mad if they find out later on that they don't get the tax treatment that they thought they were getting. So just be aware, as a QOZB, look, I mean, convertible notes are not something, they're generally these days used for bridge rounds. That is, you raised money at $10 million before, you ran out of money, and you haven't quite turned the corner where you're worth more than that $10 million. So you don't want to raise in a down round or whatever. You do a bridge round where someone essentially loans you money and says, take this money, make it into more money, and then the next round will be fine, you guys will give me my that is the most common scenario for convertible note these days. It used like sort of an old school way to do it. We could do convertible notes in the pre-seed, but I haven't really seen that much recently. Safes are just so much easier.
So with, the only question I have around safes now is I've heard locally a lot more lawyers have been able to negotiate out, when I say lawyer, I mean people that are, you know, basically okaying the deal, whatever, for their clients have negotiated out the time-based, like fundraising requirements or anything like that. Is that something that?
The safe note doesn't have an expiration date. Convertible note always has an expiration date.
I thought safes, a lot of times they put in, you know, like.
You can put it in, yes. You will sometimes see someone write, you'll sometimes see people who come up with their own safe. A famous example is the KISS note. It's called the KISS note. That I think it's 500 startups uses, or Dreamit uses, one of those big accelerator groups. They use something called a KISS note. Kind of like a safe note, but also kind of not like a safe note. And it has an expiration date. And yes, people could put it in there. If someone puts an expiration date on a safe note, take that out.
Yeah.
It would be so weird that somebody would be like, no, this is the hill I die on, is the expiration date. That'd be pretty weird in a safe note, to be honest with you.
Got it.
In convertible note, though, you want the expiration date because interest accrues. So you don't want interest to accrue forever. But then again, like I said, if you're a QSEB, you're probably going to avoid convertible notes. And frankly, if your company's doing fine, you're not going to have to deal with it anyway. And there are lots of other options to avoid valuation dip, other than convertible notes. It's just that's where it's going to come.
I'll just, to wrap up, I'll say, those of you who are Launchpad Ignite members, which most of you are or will be, consult with one of us before you take your first check, and we'll help you through details.
Yeah, bring us your term sheets.
Yep.
Me, Dan, Blake's looked at a lot of term sheets. We'll be happy to go over them with you. And we'll tell you, hey, this is crap. This part's probably negotiable. This part you can hear, and I'll tell you like specifically, like, look, he said this thing. It's kind of crazy. It's not good for you. If you tell him these specific words, they'll probably take it. It's better for everybody. There's a lot of compromise versions of these, like hard, red flags in these contracts. There's a lot of things where nobody gets everything they want, but nobody really gets hurt either. All right, that should be 9 o'clock. Everybody pretty good on everything?
Thanks.
Okay.